Good morning, it's Joe Neighbour from Signal Centre and it's the 29th of July. Today I'll be running through some charts with you all on the FX markets just to give you an update on our take on where things are headed in the short and medium term with regards to currencies. Just in terms of the headlines overnight, the Fed statement was close to expectations, but the rhetoric from Chair Powell was relatively dovish. No immediate move towards a reduction in asset purchases, which of course has helped all the risk on assets. So we've seen money coming out of what I consider safer havens, looking for riskier positions on the back of continued support from the US. We saw bond yields edge lower following Powell's comments, and risk appetite held steady on the dovish rhetoric, although Wall Street indices were a little bit mixed. So in terms of the currencies, let's get stuck into some technical action. I have in front of you today on the screen the dollar index chart, and this is the daily chart on the dollar index. And for those that have been following my videos over recent weeks, I've been very much of the opinion that the dollar index is in the process of forming a bottom. Now, it needed to overcome a couple of key resistance levels here that I've highlighted on the charts. The first one being this 93.02 level. Now, we never actually saw a close above this level on the daily chart, so a little bit of an indication that this was acting quite firmly as a resistance level and preventing the markets from moving higher. The reason I identified this as a resistance is because it was an unfilled gap on the chart, on the daily chart, between the 5th and the 6th of April, and as we say in technical analysis, gaps often get filled and they can act as resistance, and that's very much what's happened in this instance here. Above that level, the very important level for me was this 93.43 level, which it needed to overcome. That was the previous high that we posted on the 31st of March earlier this year. Had we overcome that level, then for me we would have completed quite a large double bottom pattern on the longer term charts, and that really would have opened up the upside over the medium term for higher prices. Now, that's off the table for the moment, but not to say that story is completely dead. What we have formed in recent days on the daily chart is a bit of a wedge pattern here, as you can see, that's been highlighted by these two red lines on the chart. And on the 27th of July, so just 2 days ago, we saw a break of that level on a closing basis on the daily chart, and that has been followed up with more selling. So we're now in the fourth consecutive day of selling of the dollar index. Today, we're down by almost 0.3%. Obviously a long way to go on the session. We do have some important numbers out later today, including the US GDP number. So waiting to see whether or not we do get any buyers step in on the dollar index, or whether or not we are going to see this corrective move continue. So following the break from this wedge, it looks as though we're in corrective phase with the dollar index in the short term. In terms of where we can expect price to go on the downside, I've got some Fibonacci levels on the screen here. The first of which is the 38.2% Fibonacci level, which comes in at 91.97. That would be the sort of first line in the sand to target on the downside, which could potentially act as support. Below that, we have the 50% fib level, which is at 91.36. Now, we have a bit of confluence here because we have the previous swing high, or a previous swing high back here on the 5th of May, and this marries up quite nicely with this 50% level. So this could be a level to target, potentially where we could see the price move to on the downside before the buyers do actually step back in. Below that, we can head down to the 61.8 and the 78.6. If we start to breach the 78.6, then this whole theory that I've had about the dollar index potentially bottoming out will certainly come under threat. But that also could be the point where the best risk reward is on offer for a potential move to the upside over the medium to long term on the dollar index. So not giving up on the fact that this could be bottoming out, but certainly in the short term it looks as though it's a case of selling into strength in the dollar index. And in terms of the short term targets, as I mentioned, that 38.2% fib level will be the first one for me, which is at 91.79, and an extension of that down to 91.36. Around about those levels, I'll be taking stock to see what sort of price action occurs, whether or not there is any clear evidence of support being found. Now, just very quickly before I wrap up, this obviously has a very big impact on what happens with euro dollar as well. Again, Anyone who's been watching these videos have been of the opinion that a large head and shoulders top pattern has been forming here on the daily chart. This hasn't materialized of yet. We did see a break of the neckline down here between the sort of 16th to the 26th of July. Nothing impulsive, no big break to the downside on any big volume. So for me, that hasn't completed the pattern. We need to see a little bit more. Opposite side of what we've seen in the dollar index, we formed a bit of a wedge, potentially an ending wedge here, and we are seeing a corrective move to the upside. Again, targets on the upside in the short term, 119.48, which is that 38.2% fib. Above that, we have the 50% at 120.09. So in the very short term, those would be the kind of levels I think this corrective move on the upside could potentially reach. So for now, it looks as though we are seeing a bit of relief or a corrective move in both of these markets. So look for buying dips on euro dollar, selling rallies on the dollar index in the very short term. I'll be back next week with some more roundups on the FX markets. And until then, trade safe. Goodbye.